Spain left out of the economic rebound that Germany and France seem to be experiencing. Is Europe's worst recession since World War II really coming to an end here? We're going to ask Julian Callow. He's chief European economist at Barclays Capital. He joins us now live from Barclays. Julian, why was the Spanish gross domestic product report so different from the good news we got out of France and Germany yesterday?
Good question. Well, I think you are seeing evidence that Europe is moving at really quite different speeds. And in particular, we can identify that in Germany and France, the core countries, if you like, certainly there is evidence that they have exited recession in the second quarter because they printed a positive GDP reading in Q2 yesterday, and industrial output has been on an upwards trend since May. However, in southern Europe, in Ireland, and indeed in the UK, we had some negative GDP readings for Q2, particularly so for Spain. And the reason there does seem to be that the construction sector still has a very large overhang. And in turn, there is ongoing retrenchment in construction spending in Spain. And that seems to be with us for quite a few quarters going further out. So I think Spain has got some real economic problems. But meanwhile, Germany for sure and France are showing a more solid trend. And they should be able to lift the overall Eurozone as we go through the next few quarters. So I think we will be printing some modestly positive numbers in terms of real GDP going forward.
Can we really talk, Julian, about France and Germany coming back and Spain lagging? When you hear a stat like, you know, Spain created half the new jobs in the Eurozone, according to Eurostat, at the peak of the construction boom you were just talking about. Can you really talk about a rebound in isolation? I mean, it seems like when we're talking about the Eurozone, if one's behind, it's still going to have in some way an effect on France, on Germany.
Yeah, I think you've really put your finger on it there, that we're not getting job growth in Europe right now. In fact, what's been happening is that companies have been hoarding labour, particularly in Germany and France, in the hope that things will get better. But in fact, it's quite a big danger that if we don't see an ongoing improvement coming through in demand, then because overall activity is so much weaker than it was a year ago, ultimately these companies are going to be forced to shed some of that labour that they have been hoarding. So therefore, there is quite a danger here of ongoing rises in unemployment, which could then threaten the upswing. I don't deny that, but our baseline case would be for a gradual upswing to come forward. But it's certainly a very important reason for thinking that the upswing is not going to be particularly strong. And what's more, it's going to take a very long time to generate jobs. If you go back, in fact, to the early 90s, when we last had a bad recession in Europe, though not as bad as with the one we've been experiencing recently, it actually took over 2 years after the economic recovery started before you started to see unemployment falling. That's really the way it is in Europe, is we've got very inflexible labour markets, and we've seen some very ugly productivity numbers coming through, particularly for Germany and France in the first half of this year, because companies have not been shedding labour, and that in turn, I think, will translate through into profits. So in that sense, in the US, you could say the corporate sector is much better positioned with a weaker currency and having done so much downsizing in the labour market for an upswing than in Europe, and that is likely, I think, to lead to some differentials in relative profitability performance over the next few quarters.
Is there something in the nature of the remedy being used? I mean, is there a difference in the stimulus program or how it's applied that's really making a difference among these individual countries? I mean, how successful has the stimulus program been here in the UK?
The UK has had by far the most stimulus. It's quite incredible, really, when you think about it. The Bank of England has already bought £125 billion worth of government bonds. And it said recently, last week, it's going to go out and buy another £50 billion worth. In GDP terms, that adds up to 12% of GDP. Now, Japan a few years ago, or the United States currently, are not seeing, in fact, that degree, that speed of monetary stimulus from the central bank. So that, for sure, ought to be an important factor helping the UK, if anything, to show some better signs of recovery as we go through the next few quarters relative to the rest of the euro area. The one real problem area in the UK is that it does have the most enormous budget deficit. The budget deficit in the UK in the first couple of quarters of this year was running, in fact, as it happens, also at 12% of GDP. The Bank of England's doing quite a good job of financing that at the moment, but the Bank of England can't go on doing that forever. So we do need to see
Julian,
some very
the
major
big question
fiscal
here
tightening.
for me is, can the EU withstand all of these different centrifugal forces?
I think Europe is going to gradually get through all this, but certainly what's clear is that there are a lot of problems out there. On the UK, the problem on the fiscal deficit side. In Spain and Ireland, problems on the real estate sector, to a degree in Ireland's case relating to the banking sector as well. In Italy, it's a lack of productivity. Problems in Central Europe, really, particularly again related to construction. So there's a lot of weak spots around, but suddenly overall there is quite a big policy stimulus in place, I would say.
All right. Thank you so much, Julian Callow of Barclays Capital.